So we move on to do you understand now the materiality?
Yes,
So it
I
says
do
that
understand it.
so here it says the relevance of information is affected by its nature and materiality. Now, according to paragraph
Mm,
29 of the framework, the nature of information alone is sufficient to determine its relevance. So information is material if its omission or misstatement could influence the economic decisions of users taken on the basis of financial statements. So materiality depends on the size of the item or error judged in the particular circumstances. That's why you buy a pen. You cannot present a pen in your financial statement. It's not
mm,
material. Ne?
true.
Though it's of
Yes.
importance in the business, you use it in the business, but whether
Mm-hmm.
you have that pen or not, it will not affect the decision making
It will not
purposes.
affect. It's
Yes.
true. Mm,
So the same as a motorbike with Coca-Cola, they can use it in the business, ne? But they are not their
mm.
business is not dependent on that motorbike
Because they have a lot of tracks even.
because they have a lot of trucks. The
Mm,
existence of that they really use it, yes, but the existence of that motorbike, whether it
mm,
exists or not, it will not affect their production at all. It will not affect their
oh,
business.
mm-hmm.
Yes,
Okay.
so this materiality provides this hold of cut-off point rather than being a primary qualitative characteristic, meaning that when you present now your financial statements, you should look
Mm,
at what to present. You don't just present anything that is in the business. You should look at the relevance. Is it really relevant?
mm,
You should now, when we
mm,
talk of relevance, we are referring to the materiality of that item.
mm-hmm.
Is it really worth being presented in your financial statements?
Okay.
And then we have reliability.
Mm.
So,
Period.
paragraph 31 of the framework states that in order for information to be useful, it must be reliable. Information has the quality of reliability when it is free from material error and bias, meaning that it should be your statement should be free from errors. There should be no
Mm,
errors. Do you understand?
yes. Mm,
So, and can be depended upon by the users to present faithfully that which is
mm,
either purpose to represent, meaning that
mm,
your information should be correct. Do not present information that do not even exist. Do not present a car that you do not even have.
oh,
Your information should be reliable. It should be true, out of errors, no errors. Meaning, what if your bank balance is 10,000, that should be the same
mm.
amount that you have to record.
That you have to record. Oh.
So under reliability,
Mm-hmm.
we have faithful presentation. We have different
Mm-hmm.
kind of qualities under reliability. We have faithful representation. To be reliable,
Mm-hmm.
information must be presented faithfully, and the transaction information must present faithfully the transactions and other events it either purpose to represent or could reasonably be expected to represent. Meaning all transactions and events should be faithful, they should be correct. Do not present something
Mm-hmm.
that never does not exist.
Exist. Mm,
You should present transactions that exist,
okay.
transactions or events that happened or
Oh,
that you know they will happen.
okay.
And then you have substance over form. So
Mm-hmm.
if information is to represent faithfully the transaction and other events that is purposed to present, it is necessary that they are accounted for and presented in accordance with their substance and economic reality and not merely their legal form. Meaning that they should be when you present your financial when you present the elements, the financial statements, the information should be they should be presented according to their substance or to their nature and to their economic reality. Does that thing even exist in the economy? Is it
Oh.
right in the economy? You understand?
Oh. Mm.
Okay. And then we move on
Mm.
to neutrality.
Mm.
Paragraph 36 of the framework states that information contained in financial statements must be neutral. They should be neutral, free from bias, or in other words, free from unnecessary information. Only present
Mm.
information that are necessary, that are relevant. They should be free from errors. They should be free from unnecessary information. Financial statements are not neutral if by the selection or presentation of information, they influence the decision of the making of a decision or judgment. Meaning that if you present if you leave out some information that can influence the decision making purposes, then know that your financial statements are not neutral. If, for instance, you
Mm.
have a car, or you took a
Mm.
loan, if you took a loan from the bank and you did not even
Mm.
present that loan in your financial statements, a loan can affect the decision making purposes, meaning that your information is not neutral.
Neutral.
And then you have the prudence concept. Presenters of financial information have to contend with the uncertainties that inevitably surround many events and circumstances, such as the collectability of doubtful receivables, the probable useful life of plant and equipment, and number of warranty claims that occur. So prudence is the inclusion of a degree of caution in the exercise of judgments where uncertainties exist. Meaning that,
Mm.
please go. Okay. Now, when presenting now financial information using now
Mm.
the prudency concept,
Mm.
the prudency concept states that your financial statements should not be overstated, I mean, or understated, meaning that your assets and incomes should never be overstated, and your liabilities and your expenses should never be understated.
Now, what is the meaning of stated? Sorry.
Overstated is having a higher you recorded a higher amount than it actually is.
Oh.
Overstated, you
Okay.
over presented the amount.
You- Oh, when you
Understated.
record.
And understated is when you record a less amount than it actually is.
Oh, okay.
So if you're asked to explain the prudency concept, you say that a prudency concept states that information of the business should never be overstated or understated, in a sense that your assets and income should never be overstated, and liabilities or expenses should never be understated. And that's why you have your depreciation methods, ne? That's why you have depreciation.
Mhm.
That's why you have provision for doubtful debts. You need to be making provisions, because
Mm.
when you have debtors,
Mhm.
you are not really sure whether they will all pay their accounts. They will all pay you off. You understand? So you need to make
Mhm.
provisions to avoid having overstated incomes. You need to make provisions that, okay, now looking at Sarah, there's a probability that Sarah won't be able to pay off. Remember, you already sold on credit to her, ne? But all of a sudden, Sarah
Mhm.
she just lost her job. Then you'll be like, you're looking at Sarah, she just lost her job recently. I doubt she'll even be able to pay me back. You need to make a provision that, okay, I think she's not, I don't really think she's able to pay. So I'm going to make a provision that maybe 5% of the amount that is owed to Sarah should be written off as bad debts. It's a provision. Ne? It does not mean it will happen, but you are trying to make a provision to make sure that your incomes are not overstated and your assets are not overstated. And again, depreciation. You know that if you have a non-current asset apart from rent, it will always depreciate. So you need to make a provision that, okay, I think I have a car. So my car will be losing value of 10% per annum. So you need to record depreciation. You need depreciation is an expense. You are not paying out money, but you are making a provision of how your assets are losing value to make sure that you do not just record, okay, you bought a car for 20,000, right? That does not mean that in 5 years to come you still sell that car off at 20,000. No, obviously you might even end up selling it for 5,000 or 10,000. You understand? Now the prudency concept says that your assets should not be overstated, meaning you cannot continue writing 20,000 each and every year that, okay, no, I bought my car for 20,000, so each and every year in your balance sheet you'll be recording 20,000. No, you should show that your car is losing value to make sure that your assets are not overstated. Do you understand? Do you understand? Do you understand? Damana, quickly bring the PC charger. Hurry up. PC charger, hurry up. Wait there. Wait there, can you hear me?
Yes.
Okay.
Can you hear me?
Yeah, I can hear you now.
Okay.
Yeah. Let me quickly just put this PC on charge. Yeah. Fixing it is a problem. Yeah. Give me a minute, quickly.
Okay.
My charger has a problem, so I need to fix it again. Damana, come quickly. Come fix this. I don't know what happened. I don't know. Hurry up, it will go off anytime soon. Then I'll need to restart again. Oh, no. 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 It's not charging. The problem is here. Please, it will go off anytime soon, and I don't need to go off. How many percent? Probably 7 now. Yeah. Nine percent. Nine. I'm trying to stop the recording now. Just started recording. It still looks like it. We need to buy a new charger, man. Okay. Charge it. What happened? Charge it. Charge it. It's charging. So just find a way to put it down nicely. Mm. Thank you. Poibe?
Yes.
Okay. Sorry, my charger once it's a bit not okay, so it really takes time to fix it.
Okay, it's fine.
Yeah.
Mm.
Okay, so we're talking of the prudency concept.
Mm-hmm.
So we are moving on to completeness. Completeness is another form of also falls under reliability. Now, with the completeness, it says reliable information should be complete within bounds of materiality and cost, meaning that all information or reliable information that you present, they should be complete. Do not miss out information. Ne? Meaning that if,
You must
for example,
complete.
they should be complete. Make sure that you record all information. Now, according to their materiality
Okay.
and also their cost. Okay, so all those fall under reliability. And then we move on to the next characteristic, which is comparability. Now, comparability, your financial statements should be comparable. They should be able to be compared with previous years' information and also with information of other companies doing the same business as you are doing. For instance, ShopRite and Pick n Pay, they sell similar products, right? So financial statements of ShopRite should be comparable. They should be presented or prepared in a way that they are comparable. They are able to be compared with those of Pick n Pay. So users must be able to compare the information disclosed in financial statements of an entity through time in order to identify the trends to its financial position and performance. Meaning that the user should be able to compare information in their financial statements with those of the previous years to see how the trend or how your business has been doing from the previous compared to the previous years. So the comparison of different entities must also be possible. Now, for example, ShopRite and Pick n Pay. It should also your financial statements should also be able to be compared with those of different entities in order to evaluate their relative information positions, performance, and changes in financial positions. So the measurement and disclosure of the financial effect of similar transactions must be carried out consistently over time in that entity as well as in different entities. Do you understand? Yes.
Yes.
So comparability is another characteristic. So when you present your financial information, they should be comparable. Yes. Is Mena fine? No, she's not fine. She's sick. Okay, oh, okay. Give me a minute quickly. But my mom is kind of not feeling well.
Okay.
Yeah. Okay. Poibe?
Yes.
Okay, so I'm so sorry. I'm so sorry.
Mm-hmm.
I was checking up on my mom. She's not really feeling well. Okay. So we
Okay,
move. So
but
we move on. Yeah.
we can continue.
Yeah. No, we can continue. She's oh no, she's going to the hospital now.
Okay.
Yeah. So the constraints
Oh,
of relevant and reliable information. So you have timeliness. So if information is delayed, it
mm,
may lose its relevance. So another characteristic is timeliness, meaning that you should you should prepare your financial statements on time.
time.
If
Oh,
if your financial information belongs to this year, financial
mm,
statements of this year should be presented on time. You cannot present you cannot prepare financial statements of last year this year, or maybe of 2015 this year. No, they will lose their relevance, their importance. That's why each and every year you are
mm,
required to prepare your financial statements.
mm.
Yes,
Okay.
that is timeliness. And then now we
Mm-hmm.
move on to balance between benefit and cost. The balance between benefit and cost
Mm,
is pervasive constraints rather than a qualitative characteristic. So the benefits derived from information should exceed the cost of providing it. So the evaluation of benefits and costs is substantially a judgment process. Therefore, the costs do not necessarily fall on those users who enjoy the benefit. Meaning that when you are preparing your benefit, when you are preparing your financial statements, the benefits that are
mm.
derived from the information, the benefit that you will get from presenting information should be more than the cost of providing those statements.
Oh,
You understand? You know, Elena?
yes. The benefit.
Yes, the benefit that you get from preparing those financial statements. Meaning that if you are to
Mm,
prepare your financial statements, obviously you get a lot of benefits, such as you can get loans, you can be buying on
oh,
credit, and so on. So the benefits
oh,
of
mm,
drawing of having those financial statements, they should be more than the cost. They should be more than the
okay.
cost of providing them.
Um,
Not, not playing them. So balance between qualitative characteristics. In
mm,
practice, a balancing or trade-off between qualitative characteristics is often necessary. Generally, the aim is to achieve an appropriate balance amongst the characteristics in order to meet the objective of financial statements. So
statement.
these are, for instance, now the true and fair presentation.
Mm-hmm.
Now, financial statements are frequently described as showing a true and fair view of, or as presenting fairly, the financial position, performance, and changes in financial position of an entity. Meaning that all information should be true. Do not lie. If you do not have a car, do not record the
Mm-hmm.
car. Ne? So they should be true and
Oh,
fairly presented
and fair.
always.
Mm,
Do you understand?
oh,
Do you understand?
yes.
Okay. So we move on to the measurement of the elements.
Yes. Mm,
We move on to the measurement of the elements.
financial statement.
Okay. So we're almost done with this topic. I understand we're over time, but yeah,
Mm,
let's quickly just finish off this topic.
mm,
So the measurement of elements of
okay.
financial statements. How do we measure the elements of financial
Mm-hmm.
statements? So So we have three ways of measuring elements of financial statements. So it says that measurement is the process of determining the monetary amount at which the elements of the financial positions are to be recognized and carried in the balance sheet and income statement. To what amounts? Because remember, accounting has to do with value. It has to do with numbers. It has to do with amounts. So obviously, when you are to record a car, you have to record it in monetary value. So what is the measurement? To what value do we record a car? What value do we record our financial elements with? Okay. So we have the first one is historical cost. Historical cost, that assets are recorded at the amount of cash or cash equivalent paid or the fair value of the consideration given to acquire them at the time of their acquisition. Meaning that historical cost states that assets are recorded at their cost prices. If you bought a car, let me say you bought your car from someone, né? And it's 50,000. So 50,000 is your historical cost. You understand? So the amount that you bought your car with, that's its historical cost. So liabilities are recorded at the amount of proceeds received in exchange of the obligation. Meaning, if you take a loan of 10,000 today, the historical cost of that loan is 10,000 because that's the amount that you got. Do you understand? That is the historical cost. And then the current cost. The current cost is the assets are carried at the amount of cash or cash equivalent that would have to be paid if the same or an equivalent asset was acquired currently. That simply means that if you bought, for instance, your car last year, remember we said we have to present them at their historical cost. So another way of presenting or measuring your assets is that, let's talk of iPhones. So you bought your iPhone 6, you bought your iPhone 6 Plus at 4,000 last year, ne? 4,000 last year. And then come this year, iPhones are now 3,700. That is their cost now. That is their present cost, 3,700. Meaning that last year, if you had to buy a brand new iPhone was 4,000, but then this year the value went down. The brand new iPhone 6 Plus is 3,700. Do you understand? Now the current cost says that assets are recorded or are carried with the amounts that would have been paid if you had to buy that same iPhone this year. Meaning that instead of you recording the 4,000 that you paid with the previous year, you record the amount that you could have been used this year, 3,700, because you are in 2020. But when it comes to accounting, we use historical cost. When it comes to assets and liabilities, we use historical cost and not current cost. Please take note of that.
When it comes to
assets and liabilities, we use historical cost. When we present when we measure our elements according to the historical cost and not current cost.
Okay.
Yeah.
Historical.
And then you have the realizable value. As under the realizable value, assets are carried at the amount of cash or cash equivalents that could currently be obtained by selling the asset in an ordinary disposal. Meaning that when you when under the realizable value, when you present your assets, you present them using the amount that, okay, if I'm to sell my car today, how much will I sell it for? So if I'm to sell my car today, let me say I bought my car for 50,000. And then this year you ask yourself, okay, if I'm to sell my car today, what is its market value? What is the market value of my car now? It's just 20,000. So under the realizable value, it says that you record your assets according to the amount that you could have obtained if you sell that asset today. Meaning that if I'm to sell my car today, it cost me 50,000 years back, last year. But then this year, my car, if I'm to buy the same car, it's just 50,000. I mean, if I'm to sell this car today, it's just 20,000. I can only sell it for 20,000, you see? So obviously, that is the realizable value. You understand?
Oh, yes.
Liabilities are carried at their settlement values, meaning that if you took a loan last year, obviously you won't be paying the same amount. You won't if you took a loan 5 years back of 10,000, you won't pay the exact amount 10,000. You understand?
Yes.
So it means that, okay, amount loan, instead of you writing 10,000 each and every year, for instance, yes, last year you took a loan of 10,000, so this year that same loan, it could have been maybe 10, the fair value could have been probably 15,000. So this year you will record 15,000 as if you took a loan of 15,000, because if you had to pay back that loan, it will be 15,000. That is now the realizable value. But just know that we prepare our financial statements using the historical cost.
Okay.
So these are just other types of measuring our elements. Yes.
Okay.
And then we have the present value. Assets are carried at the present discounted value of the future net cash inflows that the item is expected to generate in the normal course of the business. Meaning that now when we speak of the present value, what is the market value of that item currently? That is market what we record. Yes. How much cash inflows are we expected to get from using this asset? For instance, you have an old car, So for instance, you have an old car. Now, what is the value? What is the expected cash inflow will we receive? How much cash inflow are we expected to receive when using this old car? You understand? That is the future, the present value. Liabilities are carried at the present discounted value of the future net cash outflows that are expected to be required to settle the liabilities in the normal course of the business. The opposite of your assets. Do you understand?
Yes.
Okay. And then so this was it for unit 1. As we said that it was just theory. Unit 1 is just theory of how financial statements are presented. So you should know all the characteristics. You should know the two assumptions, that is the going concern and the accrual basis. Those are the two assumptions, and you should know all the characteristics. You should know what framework is. And you should also know the characteristics that fall under reliability and that fall under relevance. So that's the only thing that you need to know
Okay.
under this topic.
Okay.
Yeah, that was it for unit 1. So we continue with
Okay.
the next unit.
Okay.
Yeah. Thank you very much for attending. See you at 3, right?
Yes, 3.
Okay. Have a blessed day
Okay.
ahead.
You too.
Thank you.
Thank you.